Welcome to episode 2 of Bookkeeping for Small Business Owners. Today, you'll learn two of the most important concepts in bookkeeping. These are transactions and the accounting equation. These are crucial for actually doing bookkeeping, and the better you understand them, the better you'll be at bookkeeping. They also round out the foundation of our pyramid of knowledge. First, hi, my name is Christian. I'm the owner-in-chief bookkeeper here at Vitality Bookkeeping. If you're interested in getting your books taken care of, I'd be happy to help. Just visit my website, vitalitybookkeeping.net. All right. In episode 1, you learn the ethics of bookkeeping as well as the 10 accounting principles. Now we're going to start digging into how to actually do the bookkeeping itself. As we learned, bookkeeping is keeping track of how money flows through a business. The way this is done, though, is by recording transactions. What does that mean? Every time money enters or leaves a business, that event is written down. These events are called transactions. Transactions include everything from sales to purchases to loans to truly any situation where money flows through a business. Whenever a transaction happens, there are details that need to be recorded. These explain what the transaction is, including things like the date, the amount, who was involved, what accounts were affected, and so forth. We'll cover this fully in a later episode. Bookkeeping, or tracking how money flows through a business, is done first by recording transactions, which is looking at a transaction and writing down the details. Now, you might ask, how do I record transactions properly? That's where the next part of our bookkeeping pyramid of knowledge comes into play. Let's start with one of the most important concepts in bookkeeping, the accounting equation. If bookkeeping is keeping track of how money flows through a business, and this is done by recording transactions, then the first step in recording a transaction is plugging it into the accounting equation. I cannot emphasize enough just how critical this equation is. I'll put it this way. If you know how to plug transactions into the accounting equation, you can cut the time you spend on bookkeeping by, I feel like 90% would be a reasonable number. So, the accounting equation. The accounting equation is this. Assets equal liabilities plus owner's equity. Let's break that down. Assets are what a business owns. These are things like cash in business accounts, buildings in the business's name, inventory, and so forth. Liabilities are what a business owes. These are things like loans, unpaid bills, and taxes. Owner's equity is what the owner owns. Think of this like the owner's stake in the business. What the owner has claim to, in other words. Owner's equity is everything left to the owner after all the liabilities are paid. Owner's equity increases with things like owner investments and net income. Why is what the business owns different from what the owner of the business owns? Remember the economic entity assumption. For accounting purposes, businesses are considered their own separate entity. So, assets equal liabilities plus owner's equity. In other words, what a business owns is equal to the combined value of what it owes and what the owner owns. Together, all possible transactions in bookkeeping fit into one of these three categories, those being assets, liabilities, and owner's equity. I just want to reiterate, every transaction fits into one of those three. That's why it is such an important concept to learn the accounting equation. And as a quick clarification, there are two additional categories called revenues and expenses, but they're subcategories of owner's equity. So in other words, they're owner's equity, they're just categorized a little more specifically within owner's equity. We'll cover those later. For now, just focus on the main three: assets, liabilities, owner's equity. And of course, the equation is assets equals liabilities plus owner's equity. All right, another way of thinking about the accounting equation is this. Since the business isn't a person, what the business owns has to go to somebody, eventually. The left-hand side of the equation is what's up for grabs, and the right-hand side of the equation is the breakdown of who's entitled to what's up for grabs. Remember, bookkeeping is keeping track of how money flows through a business. This is done by recording transactions. And the first step in recording a transaction is plugging it into the accounting equation. So now we get to the fun part. Let's look at 5 transactions and plug them into the accounting equation together. In other words, let's actually do some bookkeeping. At least the first step. First though, let me acknowledge that this is just scratching the surface, and it's totally normal if everything is still a little confusing. Ideally, things will start to make sense as we go through these examples. That said, let's start plugging things in. Transaction number 1. Vinny opens a business and transfers $500 from his personal account to the business's bank account. How does this plug into the equation? First, let's recall the 3 options. Assets, what the business owns. Liabilities, what the business owes. And owner's equity, what the owner owns. Let's go step by step. Assets. Is this something the business owns? Yes, the business now owns $500 in cash. Liabilities. Is this something the business owes? No. There's no indication that Vinny expects his money to be repaid. Owner's equity. Is this something the owner owns? Yes. By not expecting to be repaid, Vinny putting $500 into the business is considered an investment. He now has claim to $500 of the business's assets. Final result, $500 in assets equals $0 in liabilities plus $500 in owner's equity. The equation is balanced. I want to emphasize that for every transaction, the accounting equation must balance. The two sides must be equal. Assets must equal liabilities plus owner's equity. I know the fact that it's an equation already implies this, but it can be easy to forget when you're first learning. Just remember, the accounting equation must always balance. Transaction number 2. Margaret wants to purchase a new building for her business. She gets a $100,000 business loan from the bank. Once again, let's go step by step. Assets. Is this something the business owns? Yes, the business has gained $100,000 in cash. Liabilities. Is this something the business owes? Yes, the bank explicitly loaned the money, expecting to get that money back in the future. Owner's equity. Is this something the owner owns? No. The money was loaned specifically to the business, not Margaret. Final result, $100,000 in assets equals $100,000 in liabilities plus $0 in owner's equity. At this point, you might be wondering where these transactions come from. Where do transactions come from? That is something we'll cover in episode 6, but for now, just imagine that you are the bookkeeper and these people are your clients, and that they are sending you physical receipts, or if they're not sending you physical receipts, then you are looking in their bank feeds and reading the transactions as they enter the bank feeds. Transaction number 3. Continuing from transaction number 2, Margaret uses the $100,000 in cash from the loan to purchase a new building for her business. Let's go step by step. Assets. Is this something the business owns? Yes, the business owns the new building. Margaret paid for it with the $100,000 in cash from the loan, bringing the cash asset to $0 and the building asset to $200,000 in value. Liabilities. Is this something the business owes? Yes, the cash was spent on the building, but the business still owes $100,000 to the bank. Owner's equity. No. If the loan and building purchase are the only transactions in the business, then oddly enough, Margaret would only own the business entity, but she wouldn't have claim to anything in the business itself. If there was a liquidation, for example, the building would be used to pay off the debt, and Margaret would be left with $0 in value, as she only has $0 in equity, which is a claim of $0 in assets. Final result, $100,000 in assets equals $100,000 in liabilities plus $0 in owner's equity. Let's round out our introduction with 2 common transactions that don't fit obviously into the accounting equation. Transaction number 4. Cookies Galore sells a tray of cookies to a customer for $8 in cash. Step by step. Assets. Is this something the business owns? Yes. The business earned $8 by selling the cookies. They now have $8 in cash. Liabilities. Is this something the business owes? No. The customer got the cookies they paid for. Owner's equity. Is this something the owner owns? Yes. The $8 earned from selling the tray of cookies is considered a type of owner's equity called revenue. In just a moment, I'll explain. Let's finish the problem first. Final result, $8 in assets equals $0 in liabilities plus $8 in owner's equity. All right, it's finally time to learn about revenues and expenses. Then we'll apply that learning to transaction number 5. So, what is revenue? Revenue is money the business earns. It's the money gained in exchange for goods or services, like selling cookies, landscaping, really any good or service you can think of. What are expenses? Expenses are the money a business spends to operate the business. This is the money that's used so the business can run, like when purchasing inventory, paying employees, and really anything that's ordinary and necessary for running a business. Remember, the accounting equation must always balance. For every dollar in the business, someone must have claim to that dollar. As we know from the accounting equation, assets equal liabilities plus owner's equity. When a business earns money, they earn an asset. Since the asset was earned without an expectation of repayment, that asset cannot be a liability. Therefore, the owner is the only entity that can claim this newfound asset. This is why revenue is always considered owner's equity. because only the owner has a rightful claim to it at the time of transaction. A little complex, yes, but all you need to take away from it is this. In the accounting equation, assets equal liabilities plus owner's equity. Revenue will always fall under owner's equity. Expenses also always fall under owner's equity. If revenues increase that wealth that belongs to the owner, expenses decrease the wealth that belongs to the owner. We'll go substantially more in depth on these categories and how to differentiate them in the future. For now, let's go over transaction number 5. Transaction number 5. Cookies Galore spends $20 on flyers to advertise an upcoming sale. Step by step. Assets. Is this something the business owns? No. Wait. Don't they own $20 worth of flyers? Technically, they do own the physical flyers, but this brings up an important question in bookkeeping. If a business appears to own something, how do you know whether it's an expense or something they actually own, an asset? We'll discuss this more later, but for now, let's briefly introduce it to round out the accounting equation. So, if assets are what a business owns, and Cookies Galore seems to own $20 in physical flyers, then why are these flyers considered an expense and not an asset? Expenses happen when something is used up so quickly that it might as well come directly out of the owner's pocket. The important phrase to remember here is lasting value. Expenses are things the business spends money on that don't have lasting value. And assets are things the business spends money on that do have lasting value. Think about it like this. Assets equal lasting value. Expenses equal no lasting value. There isn't a hard and fast law for lasting value, but the general rule of thumb is this. If it's used up in the short term, usually days to months, then it's an expense and doesn't have lasting value. If it's used up over the long term, usually a year or longer, then it does have lasting value and it's an asset. So, what about the flyers? The business physically owns $20 in flyers, but the flyers don't have lasting value. This is because they'll be handed out soon for an upcoming sale. Cookies Galore is paying to promote something now, not paying for an ongoing asset. That's why this is an expense and not an asset. Now, let's use this information to fill out the transaction. Assets. Is this something the business owns? The flyers are for advertising and don't have lasting value, so the flyers are not an asset. So in that regard, no. That said, this is kind of a trick question, because the $20 they spend is an asset. So, is this something the business owns? Yes, but not referring to the flyers, referring to the cash. Liabilities. Is this something the business owes? No. They've paid for the flyers in full. Owner's equity. Is this something the owner owns? Yes. The flyers don't have lasting value and are thus an expense, which reduces the owner's income. Final result, negative $20 in assets equals $0 in liabilities minus $20 in owner's equity. So just to explain what happened there, Cookies Galore spent $20 in cash, an asset, to pay for the flyers, which are an expense, because the flyers don't have lasting value. This is why the end equation is negative on both sides, because they spent $20 on something that reduced owner's equity. All right, I threw a lot at you at once. Let's review the key points. 1. Recording transactions is how a bookkeeper tracks the flow of money in a business. The first step in recording a transaction is plugging it into the accounting equation. The accounting equation is assets equal liabilities plus owner's equity. Assets are what a business owns, liabilities are what a business owes, and owner's equity is what the owner owns. Revenues and expenses are forms of owner's equity. And lasting value is how you determine if something is an asset or an expense. In order to really hammer this home, we'll be doing plenty of exercises. But first, we need to learn how to actually write down what you've plugged in. And that'll be next episode, where we go over double entry bookkeeping, the chart of accounts, and T-charts. That said, if you have anything in your mind or any questions, leave a comment. If you're interested in getting your books taken care of, visit vitalitybookkeeping.net. Otherwise, I'll see you in episode 3.